Ever wonder why a billionaire pays a lower tax rate than a school teacher? It's not because they're breaking the law, it's because they're playing a completely different game. While most Americans are focused on saving money, the wealthy are focused on shielding it. Today, we're breaking down 3 legal tax strategies used by the top 1% that you can actually start using in 2026 to keep more of your hard-earned paycheck. Let's dive in. Strategy 1, the HSA Stealth IRA. Most people think a health savings account is just for doctor visits. Wrong, it is secretly the most powerful investment vehicle in the US tax code. Why? It's the only account that is triple tax advantaged. You put money in tax-free. It grows tax-free. You take it out tax-free for medical expenses. The pro move. In 2026, the contribution limits have adjusted. If you pay for your medical bills out of pocket now and keep the receipts, you can let that HSA money compound in the S&P 500 for 20 years. Then, you can reimburse yourself decades later, tax-free. It's effectively a secondary 401k with better rules. To issue 315 strategy. 2. The Augusta Rule. Section 280A. This is a favorite for small business owners and side hustlers. Under the Augusta Rule, the IRS allows you to rent out your primary residence for up to 14 days a year without having to report any of that income. How the wealthy use it. If you have an S-Corp or an LLC, your business can rent your home for a legitimate business meeting or a board retreat. Your business gets a tax deduction for the rent expense, and you receive that rental income personally, tax-free. Just make sure you document the meeting minutes and check the local market rates for a meeting space. Don't overcharge or the IRS will knock on your door. This sounds morbid, but it's how the Forbes 400 stay rich. Taxes are only triggered when you sell an asset, capital gains. So the rich simply don't sell. Instead of selling their stocks to buy a Ferrari or a new house, they take out a S-block, a securities-backed line of credit. They borrow against their portfolio. Borrowing isn't income, so there's no tax. The interest rate is often lower than the capital gains tax. For this average viewer, this means using asset-based lending. Instead of liquidating your portfolio and hitting a massive tax bill, you use your assets as leverage. You stay invested, you keep growing, and Uncle Sam gets $0. The US tax code is 7,000 pages long. It's not designed to be fair. It's designed to incentivize certain behaviors. If you invest and run a business, the code is your best friend. If you found this helpful, hit the like button so the algorithm shows this to more people who are tired of overpaying the IRS. And subscribe for our next deep dive into 2026 wealth building strategies.